We will take a few minutes off from the direct stock markets and address a big financial issue staring at the depositors at large across the country. In fact, we have received several queries on this as well. The question where to invest in times when bank fixed deposit rates are plunging with returns further slashed by inflation and also income tax. Remember, this year already has seen about 4 repo rate cuts by the Reserve Bank of India that has brought down the repo rate to 5.25% from 6.5% seen in January of 2025. While this has definitely brought down the lending rates, so all those borrowers have had a good year because they have started to get competitive rates there, but it has dragged the fixed deposit rates down as well. Remember, they are now down more than hitting more than 2.5 crore depositors, where it hurts the most truly. Today, we focus on this, and other than stock markets, gold, real estate, what are the options for those who are actually looking for a safety of a fixed deposit but with higher returns? We're going to be focusing on this with another guest who's going to be joining the panel now. Pooja Bhinde, the certified financial planner at PB Investments, is now with us. Pooja, warm welcome. Good afternoon to you. Good to have you with us. And of course, Sudeep ji is with us constantly. We will first try and understand from you. After 4 cuts of the RBI, we have been consistently seeing that the banks have been reducing their fixed deposit rates, and now they are hovering at record low levels or near record low levels. The 1-year, 2-year returns on your screens will come in are anywhere between 6.2% to 6.7%. The lower you go in terms of tenure, you will find these returns even lesser as well. So the big question is, are the good days of investing in fixed deposits, where the maximum chunk of investors in the country really put their money, is it behind us?
Thank you so much, Sakshi, first of all. As you rightly mentioned in the beginning that, because of the rate cut, there is a good news for the loan buyers, loan borrowers. But at the same time, when you look at investors, I think transition is very important when it comes to, fixed instruments, wherein, the investors are still, I don't know, somehow hooked on to the, fixed deposits, the bank fixed deposits for that matter, I would say, wherein we all know, the word that it says that it's fixed and it's as safe. It's not really safe. We all know that there's a insurance of approximately around 5 lakh rupees to any FD attached. So the retail investor should understand the risk, and at the same time should understand and should evaluate what other options, like as we are speaking right now, the interest rates have fallen down. So I think one thing they should first, come to a conclusion, or make a financial plan wherein why are you investing in an FD, or why have you
Sure.
chosen a product like FD. So first of all, it comes to like there is some capital protection mindset to it, and
Yes,
secondly, there is a tenure that is in mind. Say, for
absolutely.
example, the tenure is for 1 to 3 years, and capital protection is something which is very important, but not return year. Because as we, talk about returns, we have other options wherein you get better returns than FD, but at the same time, there is risk and there is tenure which needs to be, given to those instruments. So I would
Absolutely.
say, debt mutual funds as a category is a very attractive category when it comes to, fixed income, I would say. I
Okay.
know the taxation and that has been at par now with the fixed
Fixed
deposits, but
deposits. Okay.
when you say debt mutual funds, there is no lock-in, there is liquidity all the time. Secondly, the taxation that occurs, it's deferred. When you actually sell that debt mutual fund, at that point the tax is levied to you. And thirdly,
Yeah.
there is also a little bit of capital appreciation there. And especially when we are talking about this right now, Sakshi, because the interest rates have fallen, the debt
Yes.
market is actually very attractive right now because
Very
it's
attractive
inversely
right now.
proportional to the bond, right? To the bond
So,
prices. So the NAVs
absolutely.
are also shooting up. So I would say somebody who is looking at a time horizon of, maybe 2 to 3 years can look at options like a short term or a medium term debt fund, a corporate debt fund, or also there is one more wonderful category which is income plus arbitrage.
Can you
This
also just side by side tell, Pooja, for all our viewers who are listening to you, as an alternative to FD, what are the kind of returns these, avenues provide to them on an average 2 to 3 year time horizon, like you're advising them to?
Yeah. So first of all, in terms of return, obviously there is no fixed return that we say as in an
Sure.
FD. But the return here we see is more in terms of the post tax returns, I would say. So, for example, if there are two products giving 7% return, and if you're in a high tax bracket, specifically when I'm talking about a high tax bracket,
Yes.
investor. So after 30%, the 7%, the post tax percent comes to approximately 4.9. And if you
Hmm.
opt for an income plus arbitrage kind of a category, wherein if you can wait for 2 years, then your taxation comes to 12.5%. So
Okay.
there around 6%. So obviously there is 1.25% of alpha there. But at the same time, you need to understand, because what is your duration to that particular
Yes.
product, that is very much important. As I mentioned, income plus arbitrage, because it's a fund of
That's a
fund.
good idea for at
Yes.
least the higher tax bracket people, right? Sudeep, let me get you into that conversation as well. Do you also believe with the falling FD rates, a large chunk of our investors in India, should they gradually shift for better avenues? And what would you advise them in case they're looking for the safety of a fixed deposit and yet are risk averse and may not want to invest in stock markets as yet?
Well, I think you never get safety of fixed deposit anywhere else. While debt fund investing is good, but interest rate moving up and down can kind of shake the balance. And if you are investing for a short duration in a debt fund, that can be give you unfortunately negative returns as well. So it's always better to be a little careful. But having said that, the opportunities are many. And instead of investing in a fixed deposit, I've been recommending investors to invest in balanced funds. Now, balanced funds invest in debt as well as equity. It's a balance between debt and equity, and they have over the last many years performed commendably well. So
Okay.
that is one category which I recommend. The other category which I've been recommending investors is multi-asset allocation fund. Now these funds invest in debt, equity, as well as commodities. Now, while I
Okay.
talk commodities, it is actually gold and silver.
Gold and silver.
So,
Hmm.
so you can understand in today's day and age where gold and silver is running away, these funds have been
Absolutely.
performing exceedingly well. So, I think both these categories of funds, multi-asset allocation fund as well as balanced funds, needs to be looked at from an investor's point of view. Of course,
Okay.
nothing is zero risk like FD, but
Yes.
this is worthwhile taking this risk.
Okay, Pooja, let me ask you to help us understand where does the small saving really fit in into this cycle? There are PPF, there is the National Savings Certificate, there is Senior Citizen Scheme, Sukanya Scheme. So many of the small saving schemes that the government is running as well. So how would you compare that with an FD vis-a-vis returns and vis-a-vis the flexibility and taxation part?
Right. So, Sakshi, because as you mentioned, when we are talking about a non-equity product and when we're talking about debt, at large, obviously small saving scheme also, is one of the category. But as you mentioned, the instruments like a PPF, which has a time horizon of 15 year, a long tenure. Okay. So people look at it as a retirement product, or, as a
Correct.
long-term investment product, which I would say, apart from your equity investments, which we also hold for long term, I think PPF also should form a part of your portfolio. There should be some asset allocation in any individual's portfolio, so that role can be played by PPF. And the other
Okay.
instruments like senior citizen, depends on if you're a senior citizen, but again there the interest is taxable, but there is a lock-in of 5 years. National savings certificate again. So I would say the interest nowhere is tax exempt apart from PPF, but PPF has a longer time duration. So, understanding the needs is very much important. Secondly, as we spoke about debt funds, I understand that returns are not made here, but at the same time, your capital protection and the taxation, the post tax returns are very much important. And thirdly, if you want to make a little more return, or generate more
Sure.
alpha, and if you have a time horizon which can go up to 3 to 5 years, then I would say the category which Sudeep clearly mentioned, like a hybrid category or a multi-asset, can work.
Sure.
Wherein equity savings fund can, actually play a good role here, because the equity is, in the range of 10 to 15%. So your risk is only that much, but at the same time, your post-tax returns are good. Yeah.
Okay, thanks a lot, Pooja, for sparing your time for us and for advising all our viewers on the debt side as well. We also have one more query coming in. Sudeepji, I'm going to be taking that query with you. Praveen Sharma from Delhi says, I'm 65 years old and I'm a pensioner with all my investments in actually fixed deposits. Now with the FD rates falling, what should I do with my investments? Where should I invest? Now here is a, kind of a situation where we have a person who's 65 years old, probably retired, and like he said, he's a pensioner. So where should he be now investing in a falling interest rate scenario? We're also contemplating, Sudeepji, that there could be one more rate cut probably going forward, so which could actually lead to fixed deposit rates probably at record low levels.
I completely agree with you, but the kind of profile which you are talking, I think unfortunately, recommending any kind of equity-related investment is not fair. But having said so, option remains only fixed deposits. So instead of having fixed deposit in a bank, I can only recommend that he can buy fixed deposit with some of the leading private companies. So Mahindra Finance comes out with fixed deposits. Bajaj Finance comes out with fixed deposit. These are credible brands. And remember, the fixed deposit rates for these companies are much better than the typical bank FD rate. So my suggestion will be stick to FD for a pensioner with 65-year age. Stick to FD, but try credible private sector FDs, which will give you better returns. If you can take little risk, again, I would mention this clearly, if you can take little risk, put a part of this money in a multi-asset allocation fund, and I think that will give you fantastic results.
Okay, so here Praveen ji, although you are 65 and a pensioner, fixed deposits you can continue, but with a private player. If not, you can go for a multi-asset allocation strategy, and in a fund like that, you could probably earn better returns as well.
If you like the video, do like, comment, share and subscribe.